This video, we are going to be looking at the Salt Lake City, Utah rental market for multifamily properties. So, as usual, you can see the filters that we have for the Salt Lake City market in CoStar. Exclude all corporate, exclude all military, exclude all senior, exclude all vacation, and we're only including market and market affordable for conventional apartments, not looking at senior, not looking at student, not looking at low income. All right, if we go to our location, we can see that we are in the Salt Lake City metro statistical area, and our map shows us that. So let's go look at the analytics. So here is our Salt Lake City supply snapshot. We can see that there are 1,791 properties in the market, totaling 88,462 units. There are still 7,898 units under construction, and only 1,319 have absorbed in the last 12 months. We can definitely see there's a slowdown in absorption because 12 months ago, the market was at 5.5% vacancy and is now sitting at 9.2% vacancy. Okay, rents still show a slight climb year over year, but we'll go into the data and see what it looks like quarter over quarter. I'm going to guess we're seeing a negative trend in the market quarter over quarter based on what we're seeing here. Again, capital markets is not applicable right now because in the capital market side, there's a big delay and the investors in the market still have not come to grips with the fact that most markets we've seen are declining in rents. So if we scroll down a little bit and we go to all so we can get our long-term occupancy average, we can see that the market is currently at 90.8% when the long-term occupancy average is 93.13, putting this pretty deep into the multifamily recession cycle in the real estate market cycle. Now, again, just for multifamily properties. But let's look at the data in the rents and see if we can confirm that. So here is the rent data for all asset classes, Class A, Class B, Class C. We look at effective rent, not asking rent, because we don't care what the owner or property manager is asking. We care what they receive. And effective rent shows us the rents that are collected. If we look at Q1 of 2022, we can see that the rents were $1,542, went up to $1,594, and then the downtrend started. They are still slightly above where they were in Q1, but are definitely trending downward. Let's look at the supply of space in the market, the deliveries, the construction, and the absorption to see if this tells us a tale. So we delivered 578 units in the first quarter of 2022 and absorbed 436. Not too terribly bad. Although we did go down in occupancy, we did go up in rents. But then we delivered another 997 units in the second quarter and only absorbed 1/3 of those. At that point, the market said, yeah, we've hit an affordability apex here and we're not going to pay your rents anymore. So we're not going to absorb these units. And so the downtrend starts from second quarter to third quarter. Then we deliver 1,891 units in the third quarter and only absorb 190. So right around 10% absorbed. Same thing happened in the fourth quarter, only about 10% absorbed. And that's definitely going to show you the trend from almost 95% occupancy all the way down to 91% occupancy. So when we look at all three asset classes, A, B, and C for multifamily properties in Salt Lake City, we are definitely seeing a declining trend. It is slowing in absorption, probably because of affordability issues, and deliveries are still continuing with another 8,486 units under construction. With this big of a slowdown, this does not bode very well for the Salt Lake City market. Looking at the data as it sits right now before we go into A, B, and C, we can see that this is definitely leaning into the recession phase of the multifamily market cycle. So let's go look at Class A properties first and see what their trend looks like. So here is the Class A data. we can see that there are 125 properties totaling 23,885 units. Again, looking at effective rent, we started the year of 2022 at 1,759 in the first quarter, went up in the second quarter to 1,818, and just like our overall, the trend started downward, down to 1,773, still above where it was in the first quarter. So if we go over to our supply side, look at deliveries, under construction, and absorption, you can see that there was a split between the deliveries of Class A's and Class B's. So the A's delivered 513, only absorbed 301, delivered 547, absorbed 561. So that's not bad from first quarter to second quarter. Second quarter absorption was pretty good, and occupancy ticked up because of it. But if we look at deliveries in the third quarter, 773, only about 60% absorbed at 435, and then that occupancy ticked down. Okay, and then we delivered another 122 and absorbed just about all of them. So absorption doesn't look too terribly bad, even though we're seeing a downtrend in the rents, which is a little surprising. But albeit the downtrend is small, it is, it's not that small. We're talking a total of 5 cents per square foot down, and it seems to be absorbing fairly decent. So that's an interesting trend. I think the market is saying that even though we are getting people moving into the new units, the rents aren't renewing. So the old leases may not be renewing and they may be moving out, but they're absorbing coming from somewhere else. This is a strange trend. This is the first time we've seen this where absorption has kept up with deliveries and still showed a downtrend in the rents. So even though we are seeing some downtrend from 90.1 to 89.3, so only 0.8% decrease in occupancy has led to a 5 cent decrease per square foot in the market. So a very interesting tale in the Class A's. A little bit of an anomaly there. Let's go see what the B's look like. So here is our Class B data. We have 431 units 431 properties in the market, totaling 39,456. If we look at our effective rent, we started the quarter at 1551, or started 2022 at 1551 in the first quarter, went up in the second quarter to 1603, and then the downtrend started with the B's. So very similar to what we saw with the A's. So let's go over to our supply side data and see if it tells a different story. So we didn't have any properties deliver in first quarter, and we absorbed 148. But now look at this. So much bigger tail here. We had 450 that delivered in the second quarter, but an additional 120 went vacant. So 450 vacant units hit the market, and an additional 120 units went vacant, increasing that vacancy in the market, or dropping that occupancy down pretty considerably. Okay, that's how that occurs. So now we deliver another 1118. So from 570 vacant, now we add another 1,118 units vacant to that, and an additional 123 units go vacant. So nothing absorbed in this second and third quarter, which definitely explains why the occupancy decreased and why the rents decreased. So from everything we've seen so far, it looks like the Class B properties are the potential problem in this market, but we'll have to wait and see what the Class C's look like to make a full determination. So let's go look at the C's. So here is our Class C data. We have 1,151 Class C properties in the market, totaling 24,459 units. Looking at our effective rent, we started the year at 1182, went up to 1224, went up to 1233, and then started that downtrend. So we've seen this a lot in a lot of the markets where the Class C markets will trend upward for the first 3 quarters and then start the downtrend in the fourth quarter. A lot of this has been due to just arbitrary rent rising from the ownership and management, because the previous markets we've looked at, the supply side with absorption and deliveries definitely showed a different tale and said it should have been declining the whole time. So let's see what Salt Lake City shows us. I haven't seen this yet, so this is a first for us. Okay, so no deliveries, and I wouldn't take 65 units being delivered as a telltale sign, because you don't deliver Class C units. CoStar probably is seeing this in a bad neighborhood and is taking that neighborhood into consideration and calling these 65 units C, even though it's a B property. But just like the other markets we've seen, once again, we have an unethical situation here where the owners are taking advantage of the renters, albeit very small negative absorption. The market is saying we do not have demand for these Class C units at these prices. We don't like this. We know they didn't go to the Bs because the Bs were in negative absorption, and C's do not jump all the way to the A's. If you're renting a Class C apartment, you are not jumping up to a Class A apartment unless you got a very big pay raise. So when we look at this, we can say that this market has definitely said no to these rents. That's all they can stand. They can't stand no more. And as we've seen with other markets, these owners and managers are just arbitrarily increasing their rents because they think they can. And the market has finally said, that's it. That's enough. We're done. And it's going to start to come down from here. All right. So once again, unethical practices by the ownership and by the management by trying to take advantage of the residents, because the demand definitely is not there to increase rents when we are showing negative absorption in the market with increasing vacancy and decreasing occupancy. But as we can see, the occupancy has only decreased 1.8% in the Class C market. So what that tells us is that the Class B properties in the Salt Lake City market are the ones that are pulling it down. So if you are a Class B investor in Salt Lake City, be very aware of what you're investing in, what those rents are. Make sure that it's cash flowing day one, that you're getting long-term debt on the deal, and that your interest rate on the debt is lower than the acquisition cap rate, not the market cap rate, the acquisition cap rate you're paying for that property. All right, so that concludes the Salt Lake City Metro Statistical Area rental market for multifamily properties update. Tomorrow, stay tuned, because we will be looking at Sacramento, California. I will see you guys tomorrow.